The perfect storm is about to hit North American stock markets. We've got it all. We've got high government debt and massive spending, continued spending. We've got tariffs. Now we've even got a war thrown into the mix. All of this spells out inflation. And inflation, with a slowing economy, means stagflation. So today we're going to talk about a strategy to deal with inflation and stagflation, meaning a stagnant economy and steady or rising inflation, and how other periods of time in history when we've seen these kind of developments, investors have made off well. My name is Keith Richards. I'm Chief Portfolio Manager and Technical Analyst and President at ValueTrend Wealth Management. And this is the Smart Money, Dumb Money show. And because you're watching it, you're smart money. To start off, I'd like to introduce you guys to a basic principle, and that is a principle that modern governments, particularly here in North America, Canada, and the United States, over the past 10 years, have invoked as part of their monetary policy. It's called modern monetary theory. And MMT, as it's often called, basically says you can spend as much as you want because you're the government and you could just print more if you got to pay it back. And I'm being a little facetious. Well, the problem with that is when you print money, you're creating more money floating around in the system. And this, in turn, causes inflation. Think of it. More money in your pocket, same amount of goods, that drives prices up. So we can track how much money is in the hands of ordinary people, let's say, through what's called M2 money supply. And again, I'm simplifying everything, and I encourage you to Google if you really want to know the proper definition of M2 money supply here, rather than just listening to me in my very abbreviated version of it. But basically, M2 money supply is cash in your pocket, cash in the bank, short-term deposits, that kind of thing, where you can access your money in a fairly short-term period of time and go buy stuff or invest. So that's M2 money supply. Now, as the government prints more and more money comes into our pockets because inflation picks up, and so we ask for a raise and we get more money in our pockets. But it's the ever, cart chasing the horse, because you've got more and more money chasing the same number of goods, and that's where the inflation comes from. So let's take a look at how M2 money supply in the United States of America has increased since 1960. You can see it was on a fairly level trajectory, and then along came 2020. Now, what happened was, without question, there was a need to do some spending to get out of the 2020 crisis, but it could be argued, very firmly argued, that they went a little bit overboard. Now, things have leveled off since then, but there's an awful lot of money that's come into the system since 2020, and you guys know this. You guys go and buy groceries. You guys go and look at housing prices and new cars and all that stuff. Everything's more expensive. That's because more money chasing same number of goods. Same thing in Canada. In fact, Mark Carney, who just replaced Justin Trudeau, who was very much a believer in modern monetary theory spending, is now poised to dethrone Trudeau as the biggest spender in Canadian history. Let's take a look at Canadian M2 money supply. So that's the amount of money that's floating around out there that you and I can spend, again, in simplistic terms. So again, we had a fairly, steady rate of money printing going on right up until 2020, and then boom, an explosion. But instead of being like the United States where things kind of leveled off, that spending in Canada has continued. And we're seeing that again in Mark Carney's budget. He's spending like a banshee, outspending Justin Trudeau. Okay, so what's the problem with all that money printing? Well, more money chasing the same amount of goods. We have deficits in the United States. Now remember, a deficit is spending more than they have coming in. So that is an excess. So that gets added to debt. So in the United States, they have $316 billion in deficit. And in Canada, which has literally 1/10 the economy of the United States, The Canadian deficit, as projected by Carney's new budget, is going to be another $220 billion excess over amount that we are making right now. Problem with that is Canada has $1.2 trillion in current debt. We're adding another 20%, which is much bigger than the deficit spending in the United States compared to the amount of debt they have. I don't know if I want to justify either one of them, but this is serious stuff, folks, because this is printing money. Now, we have tariffs coming in as well. I don't know what those levels will be. You guys don't either. We're going to find out, I guess, sometime in July. But the point is that tariffs will absolutely have an additional effect on inflation, and you guys know that. So we have a couple of situations here. We know we've got a lot of money printing still going on for some crazy reason. We have, therefore, high inflation, but we also have a slowing economy. Now, we weren't involved in a slowing economy before, and yet they kept spending money. And this is where the trouble gets in, because as you guys know, generally a government will print some money and invoke spending programs when the economy is slowing. So maybe it's justified. But the problem is the past 10 years, they've done tons of spending when there wasn't a slowing economy. So we have now a backdrop for stagflation. And that is that if we are coming into a recession, and we have on both sides of the continent, Canada and US, and we have tons of money, M2 money supply out there, you have stagflation, higher inflation, slower economy. So how do we invest in a stagflationary environment? Well, without going into too many details, I would encourage you to read a blog that I wrote recently called What the 1970s Can Teach You About Investing Today. Because the environment in the 1970s, although not precisely the same, it never is it? But there are some lessons to be gleaned from that period where we had high inflation and suppressed economy. You want to take a look at that blog because I list sectors that you can invest in, as well as other strategies to invest in that type of environment. Speaking of blogs, you guys know about the events that occurred over this weekend with the bombing in Iran on their nuclear facilities. I wrote a blog today that I think is extremely worth seeing. It's called How to Invest in Times of War. I looked at 5 similar events where Middle Eastern hostile countries were bombed by either coalitions or by the US over various reasons, and what markets did after and during those periods of time. I think it's well worth your time to take a look at that because it ties into what we're talking about today. So let's talk about some solutions to deal in a stagflationary environment. Let's first start off by looking at how markets have reacted even since November of last year, which was the election in the United States. As you guys know, if you've been following my videos and you've been following my blogs for a while, for the past year and a half, I have been talking about gold. I've been talking about commodities. I've been talking about getting out of financial assets and diversifying in a wide variety of commodities, with particular emphasis on some commodities such as gold, and other precious metals like silver, natural gas. Recently, I've been talking about, and of course, things like uranium and base metals. Well, let's take a look what's happened since the election in uh, 2024. The S&P's down 1.5%, but gold is up 30%. The commodity index itself is up about 5%, and the TSX, which is a commodity-orientated market that I began telling you first couple of days of January that the TSX was going to outperform the S&P 500. Well, it's been doing okay too on a relative basis. It's up about 3%. So let's take a look at some of those indexes very quickly. You can see the commodity index since November. So here's November, is up quite a bit higher. We can see that gold has been on a wonderful trajectory, slowing off a little bit lately. The arc has slowed off. It still looks good. It's pulled back a little bit. That's okay. I think there's a lot of upside left on gold, and I think one should diversify some of their money into gold. And I also like silver, by the way. In fact, if you've been watching any of my videos or reading my blogs, you know that I've actually been moving some money out of gold and into silver because I felt that silver would outperform. And so far, actually, silver is outperforming gold at this moment. Final I just talked about the TSX. You can see it broke out for an old level of resistance, and that's great news for TSX investors. So it's in an upward trajectory. Sure, it'll pull back, but it looks really good. Why? Because a lot of Canada's economy revolves around base materials, oil, gas, that kind of thing. I promised at the beginning of the show that I would give you specific sectors that I like in this market. And again, I strongly encourage you to read both my 1970s blog and my blog on dealing with your portfolio in times of war. Both of these are, I feel, essential reading. But in a nutshell, this is one of the charts that came out of my 1970s blog, which takes a look at what worked back then. Now, some of the sectors differ these days, but what I want you to notice is, generally speaking, it's oil and mining and minerals, which includes gold. So these days we have rare earth metals and things like uranium and stuff like that that's not going to be on this list. So we don't know how they would have done back then, and they wouldn't have done so well because there's not a big push towards EVs and a big push towards nuclear reactors. But the point is, commodities did very well during the last stagflationary period. What didn't work well? Well, everything else. In fact, things that you normally turn to during periods of strife or uncertainty, like utilities, didn't do very well. Financials didn't do so well. Retail didn't do so well. Consumer products didn't do great. So keep this in mind, that this is the time to be focusing by putting at least some of your portfolio in base metals, other types of commodities, rare earth, gold, silver, and energy. As I said before, and you can look back in my blogs, I've been a big fan of nat gas, but any type of commodity should be considered. Watch the rhythms, watch the charts, and watch this show, because I always bring you up to speed ahead of the trade. One final thing, guys. I'm on BNN tomorrow, which is Tuesday, June the 24th at 12 noon Eastern Central Time. If you can watch it, you can phone in and ask me questions on specific stocks. And it's the only time I can actually address individual stocks and questions surrounding them, because normally I can't do that on YouTube. So please watch the show, phone in for your questions, and mention you watch my videos. I'll put you at the front of the line. So thanks for watching, and we'll see you next week. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at ValueTrend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.